Well, when our next guest, joined Fast Money last time on March 4th, he called the president's tariff policy, quote, minutia in the grand scheme of things. Let's bring in Jefferies chief market strategist David Zervos. He's also CNBC contributor. David, great to have you with us. You also said the markets were massively overplaying the risks of tariffs. Here we are now. Yep. So what do we do with the sell-off? How do you view this?
So I think the tariff story for me, I was looking at the 2018 playbook, watched how it went. I think the new information really is that we have a much more MAGA Republican Party that's willing to go further on trade. Mm-hmm. That said, I actually think there's a silver lining under all this that's positive. So I don't get really bothered by the story. I actually look at it and think we're going to bring our trading partners to the table. They have a lot more to lose than we have to lose, similar to what you were saying earlier in the segment, and that we have a real chance of getting a more cooperative, fairer trading outcome, which I think has huge benefits to the U.S. Sure. I think as well that we're still early days in the deregulatory policies and the tax cut policies or the fiscal policies and the benefits from having just a significant reduction in the government footprint in the U.S. economy. So this is not, to me, the be-all, end-all. This never was. And I'll tell you something that's very interesting. I went back and looked at the price action in the beginning of 2018 when the first kind of tariff stuff started to come out in Trump 1.0. We had like 3 or 4 days with 3% moves in the S&P. We had a 10% correction in February. We had a 7% correction in March. The market got really spooked by a much smaller trade story than the one that got put with us today. Mm-hmm. So to be honest with you, I actually see how big this was and how much it was a surprise. The market didn't react nearly as much as you might have thought. But at the end of the day, aren't you also looking at a discounted cash flow that goes out forever? You're an equity investor. You're in the longest term capital there is. You're not a 2-year note trader or a 5-year note trader. So what you're thinking this does over the 5, 10, 20-year horizon, what it does to rates as well, bringing rates down, which means that 5 to 10-year horizon is even more valuable because we get a lower rate structure, I think matters a lot. You're detoxifying. I love the story. It's probably less in the trade side than it is in the reg side or the overall government sector side. And that is kind of getting the fiscal monkey off our back, get this thing that's been dragging us down, this big crowding out of the federal government from the private sector, pull those resources back into more productive uses in capital and labor. And, you're going to go through a little transition if you do it fast. People got nervous with the chainsaw. That was the thing we didn't really know how quick are we going to do it? And is it $1 trillion fast? Is it more than $1 trillion? But we'll get there. And at the end of the day, a clean patient that's not on the kind of fiscal juiced up sugar high that they've been on is a better economy, a better patient, and a better story.
So I 100% in terms of the fiscal mess that went on for a long time, really on both sides of the aisle. But let's reel it in and let's exert our clout and our leverage globally. This is what we're all saying. But I saw even some of your notes. You said, maybe a behavioral change is not a bad thing, and it leads to a better economic outcome. How are you defining that? Because you're an economist, and you understand what's going on here. In other words, at least you've worn these hats, and ultimately, was there something structurally broken about our economy that needed this type of structural change, or so it seems we're positioning for? Because everything on fiscal restraint and deregulation, 100%, animal spirits, everybody wants that, I think. I mean, I want that. But I'm just trying to understand the parts that I think the market doesn't understand is, hey, were we signing up for this? Were we signing up for, is the U.S. economy structurally need to undergo a massive change here?
I think what we need to understand on the trade side, and that's what we're talking about today, is there a need for 50% tariffs on every agricultural product going into India, or 300% tariffs on everything going into Canada that's dairy, or 700% tariffs on rice that we might sell to Japan? Does that make sense? Is that fair? Is that the right structure of trade with our trading partners? No. And I think there's a desire to fix that just from a kind of meritocratic, kind of good relationship story. Let's have a level playing field. And if you make a better product than we do on a level playing field, great, then we'll take it. If not, let's not take it. But let's not subsidize the workforces of other countries through VAT. Let's not put unfair trading practices into play. And that does need to be fixed. That's hollowed out a big chunk of our country and has probably been a big part of why the voter bases of those swing states moved toward the Republican Party away from the Democratic Party, at least starting in 2016 and again in 2024. I think that's an important story, and I think that's where he's pushing. But the even bigger story is kind of what Secretary Besson has been alluding to, much more of this detoxification of the $6.8 trillion of spending, which may even, we might find out there's an Enron moment here that $1 trillion or $2 trillion of it is just complete fraud. And we don't know that yet. We don't know whether these Social Security numbers that they found of people north of 120 or 130 years old, how many are there? Are we paying them? There's a lot more to find, but that, I think, is actually a little more nerve-wracking for the market and suggests there may be some real spending that gets pulled out. But again, you're talking about a period where you take the bad toxicity out, and the patient gets a little shaky, the patient gets a little unhappy because you're taking their sugar high away. But we have to remember what it is. It's a sugar high. It's not real growth, which is so funny because we're over there in Europe, which I was in last week, listening to German clients tell me how excited they were about deficit spending. I thought I was on the planet, frankly. But I'm like, this is you guys have been telling us this is a sugar high forever, and then we're just going to have to pay in the long run for all this excess debt that we take to do spending that's relatively unproductive. I think it's a great exercise if we can do it. It'll probably lead to a lot lower interest rates. I think this Fed will be cooperative with that. I think Jay Powell loved to see fiscal restraint, and I don't know. I'm not buying the really end of the world narrative that people are throwing out there today on a day that it feels pretty end of the world.
Well, that felt good.